fellow investors. Welcome back to Cash Flow Creator, the place where we demystify the world of finance. If you've got $1,000 burning a hole in your pocket and you're eager to make it work for you, you're in the right spot. Today, we're talking about smart strategies for small investors, how to invest $1,000 wisely and set yourself up for financial success. But before we dive into these game-changing strategies, make sure to hit that subscribe button and ring the notification bell. Let's turn that $1,000 into a powerful investment. Let's begin. In this first segment, we'll delve into the art and science of strategic asset allocation, an essential strategy for optimizing your investment portfolio. First up, we have strategic asset allocation. Strategic asset allocation involves the intentional distribution of your investments across various asset classes based on your financial goals, risk tolerance, and time horizon. Join me as we explore how this systematic approach can enhance your portfolio's performance and align with your unique investment objectives. With this said, we're going to list out the most important key concepts to be explored. Number one for us is risk-return dynamics. Uncover the delicate balance between risk and return in strategic asset allocation. Learn how to tailor your portfolio to achieve an optimal level of risk that aligns with your comfort zone while maximizing the potential for returns. Number two would be asset class characteristics. Dive deeper into the characteristics of different asset classes, including equities, fixed income, real estate, and alternative investments. Understand how each class behaves under various market conditions and discover the role they play in a well-diversified portfolio. Number three, market conditions and economic outlook. Explore how market conditions and economic outlook influence strategic asset allocation decisions. We'll discuss the importance of staying informed about global economic trends and how adjusting your asset allocation can position your portfolio for success. Number four, market conditions and economic outlook. Explore how market conditions and economic outlook influence strategic asset allocation decisions. We'll discuss the importance of staying informed about global economic trends and how adjusting your asset allocation can position your portfolio for success. Number five, tax efficiency. Uncover the impact of taxes on your investment returns and explore strategies for tax-efficient asset allocation. We'll discuss how smart tax planning can enhance your after-tax returns and contribute to long-term financial success. Now that we have these 5 key concepts listed, let us tell you how to practically apply them. To bring these concepts to life, we'll walk through a practical example of strategic asset allocation. Witness how a well-structured portfolio can weather market fluctuations and capitalize on opportunities, providing a roadmap for your own investment journey. Whether you're a seasoned investor or just starting, understanding strategic asset allocation is a game changer. Join me in this exploration of advanced investment strategies that go beyond the basics, empowering you to navigate the complex world of finance with confidence. Investing is a bit like building a sturdy house. You wouldn't want all your walls made of the same material, right? Stick around to discover how diversification is the key to a resilient investment portfolio. Now for the second investment strategy which we are going to explore today, we have embracing low-cost index funds. Let's talk about one of our favorite strategies for small investors, embracing low-cost index funds. I'll explain why index funds are a fantastic option for those starting with a modest sum. We'll go over the benefits, potential drawbacks, and how to pick the right ones. Investing doesn't always require hefty sums of money, and that's where the beauty of low-cost index funds comes into play. In this strategy, we'll explore why index funds are a fantastic option especially for individuals starting with a modest sum. Let's unravel the intricacies, weighing the benefits, considering potential drawbacks, and learning how to cherry-pick the right index funds for your financial goals. With all this being said, you'll now be presented with a list of benefits of embracing low-cost index funds. Number 1, affordability for small investors. One of the standout features of low-cost index funds is their accessibility. They offer a practical entry point for small investors who may not have substantial capital to initiate their investment journey. With minimal investment amounts, these funds open doors to a diversified portfolio. Number 3, cost-effective investing. Cost matters, especially for small investors. Low-cost index funds live up to their name by keeping fees to a minimum. Traditional actively managed funds often charge higher fees, eating into returns. With low-cost index funds, you retain more of your earnings, contributing to the overall growth of your portfolio. Number 4, market performance tracking. Index funds mirror the performance of a specific market index, such as the S&P 500. This alignment with market trends allows investors to capture overall market returns. While this strategy doesn't aim to outperform the market, it ensures that investors don't underperform it either. Number 5, simplicity and passive management. Low-cost index funds operate with simplicity and efficiency. They follow a passive management approach, meaning they replicate the performance of a predetermined index without constant buying and selling. This simplicity not only reduces management costs, but also makes them an excellent choice for investors who prefer a hands-off approach. While all of this is true, it is also very important to understand the drawbacks of the strategy. So in order for you to better understand what to look out for, we're once again going to list the most important ones out. Number 1, limited upside potential. While index funds offer stability, they may have limited upside potential compared to actively managed funds that aim to beat the market. Investors seeking high-risk, high-reward opportunities may find index funds somewhat conservative. Number 2, inclusion of poorly performing assets. Since index funds track a specific index, they include all assets within that index, including underperforming ones. This lack of active management means investors are exposed to both winners and losers in the market. Number 3, market downturn. Impact. During market downturns, index funds may experience declines as they closely mirror market movements. For investors with a lower risk tolerance, the potential for short-term losses may be a consideration. Once you understand these concepts, you will be ready to take the next step, which is understanding how to choose an index fund which is suitable to you personally. We'll make it a list once again, so it is easy for you to revisit any particular point, which we strongly recommend. Number 1, identify your investment goals. Clearly define your investment goals, whether it's long-term growth, income, or a balanced approach. Your goals will guide the selection process. Number 2, understand the index tract. Different index funds track different market segments. Understand the index the fund follows and ensure it aligns with your investment objectives. Number 3, expense ratio. Consideration: compare expense ratios. The lower, the better. This ratio represents the annual fee as a percentage of your investment. Number 4, review historical performance. While past performance doesn't guarantee future results, reviewing a fund's historical performance can provide insights into its consistency and stability. Number 5, fund size and liquidity. Consider the size and liquidity of the fund. Larger funds with higher liquidity often experience fewer price fluctuations. In conclusion, embracing low-cost index funds is a strategic move for small investors seeking a straightforward and cost-effective way to participate in the market. While they may not offer the thrill of active management, their stable, diversified approach aligns well with the long-term goals of many investors. By understanding the benefits, drawbacks, and the art of picking the right funds, you can embark on a journey of smart and affordable investing. And there you have it, smart strategies for small investors looking to make the most of their 1,000. If you found these tips helpful, give this video a thumbs up, share it with your fellow investors, and don't forget to subscribe for more investment insights. Your journey to financial growth begins now. Until next time, happy investing.